Okay, good afternoon. This is October. This is February 10th, 2023. For those of you who have that we haven't had a chance to talk with, this will probably be most likely my last time of saying Happy New Year. And so Connor and I will go through just some brief information, notes, events that have happened from beginning of the year. We'll wrap up last year, and then of course we'll talk a little bit about the forecast for this year as well. Not to make this too long, but yeah, we'll get right into the slides as well. So starting off pretty strong. I mean, some of you are starting to get your statements in the mail right now, and if you haven't done that or gotten them, stay tuned. They're on their way, and they'll be there in the next few days if they haven't arrived there already. So we are starting off with a strong year, and hopefully that continues. So let's kind of get into, I guess more of the meat and potatoes as we kind of go through the next slide.
Sorry about that.
That's okay. All right, so obviously we'll go through this pretty superficially. We've kind of beat the horse to death last year, right? We've had a lot of webinars last year, rightfully so, with all the volatility that we all experienced. Inflation obviously very high in 22. That's never a good situation for stocks and bonds to some degree, but rising interest rates and tremendous rising interest rates, we'll say, caused bonds to have their worst year in history. That's saying something. I've been doing this for 35 years. Connor, not as long as me, but typically, if we look at the last almost 50 years, cannot find a worse year in bonds. And that's always the surprising thing. A lot of geopolitical conflicts going on. Obviously the Russia-Ukraine war still going on a year later. Obviously issues with China, shutdowns, COVID, disruptions, obviously further supply chain issues as well. So these are all kind of events that really cause markets to have further volatility. But I guess the way we would explain it and the way we do try and to talk about it with each one of you on an individual basis is, the bottom line is interest rates increasing the way they did last year caused the most conservative parts of the market, specifically bonds, to have their worst year in history. And not so much in the stock side of things. Stocks had a volatile year, but not anywhere close to what they've had in the past. Certainly not even close to being the worst year, if not one of the worst years. So but bonds, whole different story. If bonds had hung in there like they normally would during volatile times, we probably would have a different conversation. So bottom line, that's kind of where we look at 22 from as we move into some of the other slides. We kind of wrap up 22. Says it right there, right? The Dow obviously is only 30 stocks, but for the year of 2022, down about 9%. That was kind of the unsung hero, if you will. NASDAQ was down about 33%. That's more your technology stocks. And the S&P 500 is your largest 500 companies, down close to 20%. Again, a lot of volatility there, and obviously all three indices experience a poor, difficult year, but nowhere close to what it's lost in the past. It doesn't even surprise us. Connor, anything you want to add to that one?
No, I mean, a lot of the volatility makes sense, but yeah, just a tough year across the board. But obviously, on the stock side of things, we've seen years like this before. I mean, it wasn't even down 10% a year end. Again, like you mentioned, only 30 companies, but even the S&P ended the year below 20%. But yeah, tough year all around, and stocks included.
Yeah. Okay, so once we kind of move towards the new slide, a lot of turbulence last year. And when you kind of look at up or down days where we have 1% or more, we had 122 times in just is this for the calendar year, Connor, or just for the first 6 months?
This is just for the first 6 months of last year.
Yeah, so through June 30th of last year, we had 122 times where the market moved 1% down or up. 46 times just in the first 6 months where we experienced 2% moves up or down, and then 12 times we experienced 3% moves in one particular day. That's unbelievable. And you can see that, this is really just experiencing the first 6 months of 2022. And, we can look back from 1998 until 2022. That's 24 years of information. And nobody is even close during those first 6 months to what we experienced in 2022. So that should give you some idea as far as the volatility experienced. We talk about this all the time, right, Connor? I mean, typically prior to 2022, this is bonds, worst year in bonds ever from 1976. So you're looking at, 46 years of information. And prior to 2022's abysmal performance, 1994 was the worst year in bonds, and we lost 3%. So, obviously compared to last year, bonds lost 13% in 1 year. And, we talk about this all the time. I mean, bonds are simple instruments. There's no growth to bonds with any kind of bond, government, corporate, municipal. The premise is you're lending your money to an entity. If it's a government, you're lending it in the form of government bonds. You're going to be repaid exactly what you gave them, not a penny more, not a penny less at the time they're done with it. And along the way, every year, you're going to get an agreed upon interest payment. Usually it's monthly. In our case, it is monthly. So, typically they're very stable, usually stable investments, some volatility, but not a lot. And when you look at that 46 years of information, including 2022, it's 5 years over the whole 46 years where we even lost money in bonds. And, 3 of them were less than 2% drops in bonds, but last year, that's a humdinger, right? 13% drop in 1 year because we had a Fed that was very aggressive. They raised rates dramatically. Not that they had a lot more meetings, but the fact that they had 4 meetings in a row where they increased interest rates 0.75% each meeting, in a row, to try and stem and calm down inflation and just kind of try and stomp it out. That they certainly weren't successful, but certainly we are seeing inflation come down. So maybe you could argue that they were, but basically, yeah, that's this slide just fascinates us to see double-digit losses in bonds. Probably one of the most conservative places to be invested. We had government bonds losing double digits last year. That just blows us away, but it should blow everybody away. I mean, you're what anyone experienced in bonds last year should be most likely the worst year you ever see going forward. That's the first time it's happened in 46 years. First time it happened in history. We can't find another time period where we lost 13% in bonds, but this is the reality of it. So that really caused a lot of issues, especially for bonds, our most conservative place to be.
Yeah.
You take this one, Connor.
Yeah, this is a kind of a good transition. Pretty much what Dan was talking about here with the Fed and their aggressive rate hikes. I mean, if you look at recent years of those rate hiking cycles, never have they been more aggressive raising interest rates. I mean, fast and large quantities. I mean, look how quick they get to 4.5%. Um, and the short time period, number of months it took to get there, pretty shocking. So that's really where you see the volatility with the bonds, and why they got beat so bad this year. It's just because of the aggressive Fed. They were very hawkish, and they were very quick to and doing the large quantities of these rate hikes. It's something that we haven't seen in any of these recent cycles. So.
Yeah, it's a great slide. Good story, right? I mean, if you look at this year, year to date, really just kind of through the first, this charts as of the 27th of January. So we barely had on 1 month. And the Dow rebounded 2.5% for that 1 month. I mean, it's given back some in the last, let's say, 10 days.
Yeah.
The NASDAQ, which is your technology, down 33% last year, up 11 in the first 27 days of January of 2023. And the S&P, better barometer, up around 6% for the first 27 days. And the bonds, which is basically the great story, and something that you're going to hear us talk a lot more about in 2023, is bonds in general have increased 2%. Now, most of what you're going to receive in a bond, as I just said, is the interest payment. So, and because they pay monthly dividends, we've only gotten really January's monthly payment for any bond that you may own. We've got 11 more monthly checks that are going to be put into your accounts for any bonds that you do own, that will be reinvested, over those next 11 months. So, it's a good start when we see not only the dividend being paid in January, but the fact that the share price, maybe starts to repair itself. And the only way that happens is if the Treasury and the 10-year Treasury starts to move back on its own. And that's exactly what's happened. I mean, the 10-year Treasury started at 3.8%. And, let's say through the first 27 days of January, it was down between 3.4, 3.5. Now, that doesn't sound like a lot, but when you start off the year at 3.8, that's almost a 7 to 8% increase in the Treasury going back in the opposite direction. And that's in spite of the fact that the Fed is still increasing interest rates. I mean, February 1st, the Fed increased interest rates another 0.25%, even though here we are when bonds doing well in January. And that's strictly because the 10-year is moving by itself on its own, in spite of what the Fed's doing or not doing. And so good story all around, good start all around. We think that there's more volatility still to come, but probably more in stocks than bonds. First half of this year, we're expecting a lot more volatility, and who knows? I mean, we'd love to be wrong on that, but typically it's not over yet, right? Let's keep our heads, and certainly, we think that bonds will come back a little quick, or could come back a little quicker than stocks, just for the reason that basically they're tied to interest rates. And if interest rates start to come back down again, because we have a further slowdown, and we're seeing that across the board in a lot of these companies that are announcing layoffs, and some of the slides will show you upcoming. So it's a good story.
So I thought this was a really interesting slide here, of U.S. single family home sales, and kind of the effect that not only that it's had on supply, but just the interest rates going from, at the end of 21, it was under 3%, and it got up to about 7.25. So that type of increase in interest rates is really going to hurt the home market, and it really did in 2022. As you could see, the drop down to pretty much down to the pre-pandemic levels but pretty rapid decrease. So you're definitely starting to see the slowdown in home sales across the board. Maybe in some areas not so much, but I think that you're really starting to see it there and in other areas as well.
Yeah, I can't agree more. I mean, when you look at the difference, let's say in the New York Dutchess County area, for example, that first time home purchase market's still doing okay, right? That three to $400,000 range. That's a first time home purchase up here. That's still doing all right. You know, that's someone who's looking to stop renting and buy their first home.
Mhm.
But but there's no more bidding wars, right? Those three to $400,000 homes are coming on the market, and but there's not 10 offers being made on those homes like it was at the beginning of 22, end of 21. The difference here is that mid-range home, that five to $700,000 home, where someone is most likely selling their first home that they've been in for a while, the one they bought for three or $400,000. And now they're looking, the family's getting a little bigger, so they're going to sell that home, that first home, and now move up to that five to $700,000 range. That part of the market's dead, dead. Like no one wants to do that because people have options. People are that are going to move up to that next home. They're going to say, wait a second, mortgage rates were 2.75 at the end of 21 for 30 years. And now they're, let's say 6 or 7%. I'm going to wait. I'm in no rush. I'm going to wait for that to come back down a bit again. And I'm going to not put that house in the market right now. And I'm not going to put myself in a situation where I'm paying a 7% 30-year mortgage. So that's that second tier market that's really having difficulty right now, as you can see from the existing home sales right now. I mean, you're talking about almost a 50% decrease in the amount of homes that are basically representing the single family home market. And it's dead. I mean, like I said, that first time home purchase, totally different story. Now, areas like Florida and stuff, that they're not experiencing any of this right now. You know, that's somewhat resilient. Vacationers, people that are older buying homes down there. They're selling a home up here and buying, let's say, their dream home, or maybe even, let's face it, anytime you have most people going from New York to Florida, you're going to save money. Maybe not necessarily in the real estate price, but you're not going to be paying any more state income taxes. Your school and land taxes are going to be a lot less. So a lot of people like that, it's all about the carrying cost, the recurring carrying cost versus paying a little bit more for your dream home and possibly your last home you ever buy. So quite a difference here, but that's a big part of this, and that's a great slide.
So this is an issue from a consumer standpoint. Obviously, it's kind of been in the news a little bit, but credit card debt is getting to our highest level ever. We're at over 900 billion, almost to $1 trillion of credit card debt. So this is the consumers, and really that's where you're starting to see the slowdown is obviously with more debt, they're not going to be able to make those purchases with the interest rates going up. That's also affecting credit card payments. So a lot of these things together are starting to affect the consumer to a point where we're going to start to see a more further slowdown. Obviously, cutting back is going to be a real thing when people can't afford to do certain things.
Yeah, I love it. Connor and I were talking to many of you at the end of 21, talking about how low credit card debt was. It was the lowest point it ever had been at. That's how good the consumer was in, as far as shape goes. Now, totally opposite, just a year later. But when you increase the interest rates that quickly, it's going to have an impact. And look at the companies right now that are laying off people. Disney is another story yesterday coming out, more layoffs across the board. It's becoming a lot more difficult to either one, avoid a recession at some point, and two, hard for the consumer to continue to support this economy and keep it going when more layoffs, inflation on prices. Look what we're spending in the grocery store, and obviously, what we're spending for home heating oil, those kind of things that are a commodity that's very high right now. So it's really doing a number on the consumer.
I just wanted to include some good news in all of this. While we do think that we are seeing a slowdown, could possibly lead to a recession, generally markets are going to react quicker. I mean, when they come out and say that we're in a recession, the market's not just going to drop. They've already kind of priced that in. So we will see a rebound before a recession is over. So when we do have a bear market, however, you generally see a nice increase the year following it. And last year, obviously, we did go into a bear market. We were down more than 20%. So generally, the average correction is down 30%, and the 1 year after those lows are up 30%. So generally, they'll start to rebound in a year following. Hopefully that is the case, but like we said, we'll see a little bit of volatility here in the first half of the year because as earnings come in, as we get more data on inflation and jobs reports, there's going to be volatility with that. But maybe by the second half of this year, stocks should see some nice recovery as well. Dan, you got anything else to add to that?
No, it's good.
And I think we showed this also on the last one, just the rebound after midterm elections. It seems like there's a trend that is with it. It could be because one party controlling switches over, and now it's more equal. You'll see a nice recovery from that. But generally, after midterm elections, the stock market does pretty well. So, and obviously that would be this year.
Yeah, good synopsis. So, typically I think this year, I mean, obviously last year we tried to get you to not pay attention to your portfolio, and try and trust in your plan to know that it's still working and it's in good shape. And now, right now, we're starting to hopefully, turn the corner with that and recover from last year's volatility and drops as well, especially in the bond areas. But and then of course always reach out if you have any questions. So we're excited about the most conservative places to be invested, and that's bonds. Just because bonds have really never had a result like we experienced in 2022. The fact that we could potentially do very well in bonds for maybe the next couple of years in a row, as maybe rates start to get low to drop. If we do go into recession and the Fed has to jumpstart the economy, that's typically what they'll do, is they'll start to lower those interest rates. The key thing is getting them first to stop increasing interest rates. That's the first order of business. And then after that, they may at some point fairly soon start to drop those interest rates, and then getting an inflation back from closer to 8.8% at the peak last year. It's a good start. It's already down in the sixes with inflation. And there's some that think that inflation could be down between 3 and 4% by the end of this year. So, I'm not sure if that's the case or not, but we think it's going to continue to continue to come down as well. So always reach out if you have any questions. We're in the process right now of getting in touch with anyone that is due for the review right now in January and February. We've had a ton of meetings already. If you feel that you don't want to wait for your review, you can always call us and get on the schedule now, and this way we can have that that one-on-one consultation as well. I mean, that's really what our job is to make sure that we're not only looking at the big picture, but we're also looking at meeting individually with you, and as often as you'd like, to go over and see how it's affected you. That's all you care about. You care about how it's affecting you and what our plan is for you, and getting back on track again. So that's our focus as well. So those are the three things that we always want you to kind of focus on as well. So, typically, again, as we kind of go towards the, and into February started off as very volatile, especially in the markets, and somewhat into the bond market too, a little bit. But we're going to probably see more of these volatile situations until we get some further clarity, until you start to see, are these rate increases that they had, have they done exactly the trick? Do we avoid a recession? Do we not? There's still some things up in the air. So, we want to be aware of it, but we don't think we're going to experience the kind of volatility that you're going to experience last year, in your monthly statements in your portfolios. Certainly the more aggressive portfolios could see a lot more volatility if we don't have a lot of bonds in there. But if we do go further into a recession and can't avoid one, then the good news is that bonds will start to, potentially, could potentially profit from that as rates start to come back down again. So there'll be positive things along the way, but if you have any questions at all, please don't hesitate to contact us. We'll be putting out a lot of webinars again this year, like last year. Maybe not too, maybe not as many, but the goal is to put as many out as possible. Even though many of you may not feel you need to watch them, the fact that they're out there, may make you feel good to know that you can. And that's our aim as well, besides putting out, our written pieces as well. Right now it's tax season. Of course, many of you know that, that's what we do in February through April is, we do a lot of tax returns for you. So we're deep in that process as well. Getting that kind of figured out, people coming in, getting their tax returns completed. So if any of those things are important to you as well, you have questions on it, you can always reach out to us as well, about that as well. So Connor, anything else?
Not really. I just wanted to say I'm obviously available for anybody if they have questions, concerns. I'm happy to walk you through everything, but I think we're in for a much better year than 2022. I know that's not saying much, but I think we should be in better shape. But of course, if you have questions along the way, always here to talk.
Yeah. All right. Well, again, thank you for your time. Hopefully this wasn't too long today. We tried to keep it about 20 minutes. So if you have any questions, just give us a shout, and we will make sure that we see every one of you at least once this year, if not more. But please reach out if you have any questions, and enjoy the weekend. It's February. It's at least, kind of nice, on the East Coast. Here it is, February 10th. And it's a beautiful day out there in the Northeast. And, we want to have that continued, no snow for the rest of the winter. So we shall see if that cooperates or not, but contact us if you have any questions at all. Thanks for listening.
Take care.